Hey everybody, this is Uncle Gary, and as promised, this episode is going to be on refinancing your mortgage. This is part 1 of 2. This is the primer and foundational vocabulary episode. So if you understand the mortgage vocabulary, you know what all the words involved in getting a mortgage are: open, close, fixed, variable, all those fun words. If you know what that is, go ahead and skip to video number 2. And if you'd like a refresher or just to get a retake on anything that may be different in your market, go ahead and stay with us on this video. So let's go ahead and jump right in. Okay, so let's jump in and pull up what we're going to be covering off today. Today we're going to have a little bit of fun with mortgages. And I know that's not really where you think fun is normally had, but this is your Uncle Gary, so it's going to be a relatively quick conversation. We're going to go through some of the foundational terms. I promise you'll get something from it and it'll be worth your while. And if you're not sure of a term, go ahead and make a note down in the comments below. You can like and subscribe so that you get more videos like this. And I'm going to tell you a little something about that no one else is probably going to tell you, okay? In this video, I'm going to show you how you can save yourself over $100,000 on your mortgage. Now, it does depend a little bit on how big your mortgage is. And I'm not using this to try and freak you out or scare you, but there's literally hundreds of thousands of dollars available if you didn't understand how a mortgage works. I'm going to show you that. I don't know how many uncles you got, but there can't be that many that are going to save you $100,000. So thank you for watching, and let's go ahead and jump right in. First off, we're going to talk about what a mortgage is. And in this introduction, we'll cover off the vocabulary, things you need to know before you go. You've got to learn the words and the moving parts. And then you can think of all of the long-term success ideas that come with owning a mortgage. So avoiding overpaying interest. It's like hundreds of thousands of dollars of interest if you overpay that you don't need to be paying. So you've got to think long-term when it comes to a mortgage. It's a longer-term instrument. And then knowing how to pick the best mortgage for you. Should it be fixed? Should it be variable, long, short, open, close? There's so many of these words that don't sort of make that much sense. So it's really, really critical to understand what that is. And when we talk about what a mortgage is, it's a specific type of loan that you get from a bank or a lender that is secured against a piece of real estate. That's like a house or a condo, a building, a cottage. So that's all it is. It's a type of loan, and it is used to get a loan against a real estate asset or a real estate piece of property. So the person who lends you the money, whether it's a lender or a bank, they own the property until you pay them back. Okay, you don't actually own the property. The title rests with the lender, and they own the property, and then it's usually for larger amounts of money. So you don't get a mortgage for a very small amount of money. It's unusual. It's usually larger amounts of money, so that mortgage loans are designed to last over multiple years and even multiple decades. So that's something to know about mortgages. In terms of times and terms and things like that, you'll hear about a mortgage term. That's the current contract that you're in. You can go through a number of contracts inside of a mortgage. It's the length of time that you're committing to a specific rate, a specific lender, and specific conditions set out with that lender. So the length of the current contract at the end of which you get to renew. So you'll hear people saying, I've got a mortgage renewal coming up, or a mortgage refinance where you break the term. Mortgage terms can be 1, 2, 3, 4, sometimes 5, 10. Most often they're usually 5-year. I like to tell people you may want to consider doing a 3-year term. It's not very common that you hear that recommendation, but what I've seen in the exposure that I've had as your Uncle Gary is life tends to happen around the 3-year mark. That's really what I've seen. So it's not a hard rule. You don't have to. Many people choose 5-year because they think, well, then I know what my mortgage payments are going to be, and it's stable, and I know everything. But I've seen so many times people say, it's been about 3.5 years, and now I want to do something, and you end up breaking out of a mortgage. And not unlike this time now where interest rates are really low. So in the second video, I'm going to tell you why you want to consider refinancing your mortgage right now. Okay. In terms of mortgage terms, this one's an interesting one. So what we're going to see here is a few items around fixed, which is where the interest rate is not going to change for the term of the mortgage. And that may have benefits for you. If you think interest rates are going up, you fix the interest rate so that you are assured it will not go higher on you and change how much you get to pay each month. So a fixed interest rate is not able to change for the life or the duration of the term. The next one is a variable interest rate. And a variable interest rate, as you would expect, is able to change along the life of the term. So that's a useful point to note. The way that the US market refers to this is an ARM, or an adjustable rate mortgage. They usually quote it with two numbers, a number and a slash and then another number. So you'll hear a 228 or a 5 by 1. And that means things like 2 years are fixed, 28 years are variable, or 5 years fixed, 1 year variable and it repeats, or 5 years fixed and then 5 years variable. And that is usually set with an index rate. They arrive at a rate at which they base the mortgages, and then they add a margin on depending on the lender you go to. Now in Canada, we just refer to them as variable rate mortgages. We don't use the term ARM or anything like that. And they're derived by going to the Bank of Canada. They set a rate at the Bank of Canada, and then each lender will add a margin, an X%. So it'll be like a half or minus a half or plus a half, and so on. And many people think, well, fixed is for me, and I love that because I'm sure of what my payments are going to be. But I'll give you a few reasons why you may want to consider variable from time to time. It's not, there's no wrong answer, but just consider that fixed isn't always the best, even though everyone has told you, oh, fixed is great. If we look back over the last 15 years, mortgage rates have been dropping consistently. So if you had picked variable, you'd have actually won out more often than not. But many people want to know just for the safety reason that they want to fix their payments. Okay, let's look at some conditions. In terms of conditions, you can have an open mortgage and a closed mortgage. So let's dive into that one. Open means you can pay off the entire mortgage at any time. This is better for shorter mortgages, quick in and out mortgages. I only need it for a year or two just while I'm doing something, a renovation, I'm buying a new property, something like that. It signals an intention to effectively be able to exit the mortgage quickly, so you can pay it off without penalty. A closed mortgage is one where you will be incurring a penalty if you try and exit the mortgage during the term. This is not a bad thing. Most people go with a closed mortgage if they're expecting to pay their house off, or their holiday house, or their whatever building. There's no intention to exit prematurely. So what that does is it gives you a better rate. Usually the rate is lower on a closed, because then the lender is assured that they have a steady stream of income. The lenders are basing their forecasts on how much money they're going to make and so on. So they want to know that there's not going to be any misses or hiccups in their income. And so they like to lock in a closed as well. So closed can work for you. It can work for a lender. And open, if you know that you're going to be in and out of a market faster than you think, then open is a much better plan. Next up, we'll talk about the interest rate. So the interest rate you'll hear is actually made up of a few numbers. The US market refer to an index rate. Sometimes you might even hear the term LIBOR, L-I-B-O-R. And this is an acronym. It's for a London interbank rate that is basically a worldwide rate that some of the banks use to trade with each other. And that's often used for mortgages. Other ones, it's just an index rate. Sometimes it's the maturing of a treasury bond in the US. So there are a number of places the index rate comes from. But if you ask your lender, they'll tell you where they're getting the rate, the index rate. And then they add on a margin or a premium, a couple of points. You might hear them say, yeah, there are a few points on that. So that's where they add a margin for the lender, because the lender is basically saying, if I went and got the money somewhere else, how much am I adding on to give you the pleasure of giving you this mortgage? In Canada, there is no LIBOR or index. It's known as the Bank of Canada rate, or the prime rate. So prime plus a percent, you'll hear things in Canada like prime plus 0.25 or prime minus 0.3. This equals an effective rate. If you take what the prime rate is, let's say prime is 2.5%, and you subtract 0.3, then you'll get down to 2.2. And that's the effective rate. So lower is obviously better, and you can negotiate the percent of the premium, the X part of the X percent, you negotiate that with the lender. So the more they give you off, the better off you are. And lastly, the Bank of Canada changes their rate from time to time based on what they see the economic conditions of the country. So if they want to stimulate the economy, they may change the rate by lowering it. If they want to try and drive up and tighten up some lending standards, they drive the rate up a little bit. So that's a pretty important point. We'll cover that one again in section 2 of this video, or part 2. Now we get to a fun conversation, which is amortization. Very few people know where the word amortization comes from, and I actually went and looked it up because I'm kind of like that. I'm your Uncle Gary. Amortization is from the Latin root of the word mort, which is, if you speak Spanish or you speak any of the Latin rooted languages, mort is to die or death. And so this is the time along which the mortgage will live, or the death point at which the mortgage will die. So the length of time it takes you to pay off the entire mortgage is the amortization, where you spread out the payments until the mortgage dies. So it's the total life of the mortgage. And it can be usually 10-year, 20-year, 25, sometimes even 30 and beyond. Now, most often I see 25-year mortgages. That's a common number. The longer you make the amortization, the lower it makes your payments look. And the shorter the amortization, like 10-year, it makes your payments a lot higher because you've got to pay off so much more quickly. So it's not to say that you should just make it the longest amortization. If you make it too long, you actually end up paying so much interest, so much premium to the lender that it's really unattractive. And I'll show you a little bit about that in part number 2. So important items to note: principal. The principal of the loan is how much you actually loaned from the original lender, from the actual amount you got a loan on. So if you have, let's say, a $500,000 house, you loaned $500,000 as the principal. The interest portion of your loan is how much the lender is charging you for the pleasure of giving you that mortgage. It's their fee, their income is interest. So the two are not equal for each payment. This is key. If you get nothing else, get this. The two are not equal each month, which means most people think, oh, well, I'm just paying off interest and principal in equal proportion. You are not. The bank or the lender is front-end loading the interest payment. They charge you more interest earlier on in the mortgage and then slowly taper it down. So they make their money for themselves first. You end up paying down your principal second, in that order. It's really, really important to know that. So if I show you a couple of things on payment frequency, I might even just quickly skip over to looking at whether you pay monthly or bi-weekly. Each of these is an option for how regularly you want to pay the mortgage. And the one I like the most is accelerated bi-weekly. Now, a lot of people say, well, yeah, but monthly is easier. It just goes off once a month, and why do I care? You know, once a month equals 12 payments a year. What's the problem with that? Other people say, well, I'm going to do it bi-weekly because I get paid weekly, and I don't want to know that I, ran out of money at the end of the month or something. If I pay a big amount, I get nothing for 2 weeks because I've used my whole paycheck to pay one mortgage payment. So bi-weekly matches when you get paid. That's a value proposition there. Weekly and accelerated weekly, there are other reasons there, but the one to watch is accelerated bi-weekly. That's a special one. And the reason it's special is because they divide your payments of what you would have paid per month into half. So they take 1 month payment into 2 half payments. And if you do the 2 half payments and you do them every second week, so this isn't basically taking into account that some months are 30 days, some months are 28, some months are 31. It basically takes 12 months of the year. If you multiply out how many weeks there are, it's 52. And if you're going to be paying every 2 weeks, then that would be 26 times you will pay. And if you take 26 half payments, and you divide obviously by 2 to get to full payments, you actually find that the answer is 13. 13 full payments, 26 half payments are made in accelerated bi-weekly. So you're effectively spreading a 13th payment in a very, very thin amount across the whole year. So it's a little bit more, literally, it's a few dollars more, but it makes a massive difference to how quickly you pay off the mortgage. And I'm going to show you an example of that. So it's really key. 13 monthly payments come with the accelerated bi-weekly, but you won't really notice it. I think most people don't notice if they went to accelerated bi-weekly. But if you watch part 2 of this video series, you will see I'm talking hundreds of thousands of dollars of difference if you do that versus paying just monthly. I do want to revisit one point, really key. I mentioned a few moments ago that the principal and the interest payments are not equal. And this is a really clear indication. The payments for principal and the payments for interest do not go off at the same rate. So if someone is lending you money for a mortgage, let's say it's a bank or a lender, they want their money first. They're going to charge you interest first. So that is a really key point. The key for you is to get to pay off your principal as fast as possible. The bank or the lender recalculates the interest that you get to pay every so often. So the faster you pay down the principal portion, the faster you can lower the amount of interest you pay and get done with paying off your loan. Now let's look at a quick comparison. So I'm going to show you here scenario A, scenario B. The one is a shorter amortization, the other one is a longer amortization. So one is 25 years, another one is 30 years. The mortgage amount is the same at $500,000, and just the amortization period is different. And let's say, for argument's sake, you got your mortgage 3-4 years ago at 3.5, it was a great rate, and your monthly payments are 2,496 at 25 years, or 2,238 at 30 years. And obviously many people would think, well, great, I'll pay less. I'll do the 30-year amortization. What's wrong with that? It's 2,238 versus 2,496 every month. I would rather pay less money. So you end up paying less by $258. What you don't realize is that the amount of interest that makes you have to pay over the life of the mortgage is the difference between 248 So 248,000, almost 249,000 versus 305,000. So you end up paying $56,000 of interest more just for saving $250 a month. Now, I don't think that's worth it. I think if you do that multiplication, you'll find out that it actually pays you to rather pay $200 more and then save yourself $56,000. And I'll show you another reason why. It's not as straight and cut and dried as that, but that's one indication why a slightly shorter mortgage may be better for you. Slightly shorter amortization there. Here's another comparison that I'll show you, scenario C and D. This is where you go from monthly payments to accelerated bi-weekly payments. So if we look at scenario D, same mortgage, $500,000. We've gone with 25 years, 3.5% interest. 2,496 is the monthly payment. And if we look at scenario C, as I mentioned, they divide the payments in half every 2 weeks. And so the effective amount you would pay with scenario C, if accelerated bi-weekly, is actually $2,700. So it's $200 more a month. Now, if you do that and you show those $1,248 every second week and you multiply that out, it's 13 payments. So you're making one extra payment per year. And as long as you can afford it, you can pay that 13th payment down and watch what it does. The difference, if you just change how frequently you pay, then you get the difference between almost 249,000 for scenario D and 216,000 for scenario C. That's $32,000 if you're willing to separate out $200 extra a month and pay bi-weekly. Really, really important. So the next piece I'm going to go through is part 2 of this video. I'm going to show you an amazing app alert in there. You want to really look at that one. I'm going to suggest you consider refinancing now. I'll actually tell you what some rates are that are happening at this point, which is late in December 2020. And I'm going to talk a little bit about the market direction. Now that you know all of these vocabulary words and things like that, it's going to be a lot easier to understand what there is to do with refinancing your mortgage and why this is such an awesome time to save hundreds of thousands of dollars. Okay, so that's pretty much what I wanted to show you as the foundational vocabulary of a mortgage. You now get a sense of how valuable accelerated bi-weekly payments are. You also see that the amount of interest you pay is front-end loaded. So the faster you can pay down principal and retire that principal, the faster you pay off the mortgage, the less interest you end up paying. You get nothing back for the interest. At least with the principal, you pay back money you actively lent, whereas with the interest, you just end up paying that as fees to the lender, which is how they make their money. There's nothing wrong with that, but that doesn't mean we have to pay as much of it as possible. We can minimize it. So go ahead, like and subscribe. If this content is appealing to you, please share this with someone. Many people do not know that their spouse doesn't actually understand how a mortgage works. And there's nothing wrong with that. No one's born understanding how a mortgage works. We all had to learn this information somewhere. I had to learn it. I had to read up. I had to ask lots of questions. So my suggestion and my invitation for you as Uncle Gary is send this to your spouse. Ask them if this video makes a difference for them and have them subscribe or have them like or send it to anyone else that, if they're thinking about it, would love to understand how a mortgage works. Because most often than not in relationships, I find one person decides and the other person doesn't really get to be involved in the conversation. So they don't have to change that, but at least knowing that everyone is afforded an opportunity to understand is really valuable. So go ahead, send it to a spouse or your spouse or someone's spouse. And as I mentioned, there'll be a link to part number 2 in the description. So go ahead and watch that. It's going to be a game changer when you see what I'm going to show you in that next video. Like, mind blown. It is awesome. So thank you for watching, and we'll see you on the next one.